I am Ben Carlson. This is Ask the Compound, the show where you provide the questions and we provide the answers. Is it irresponsible for a financial advisor to recommend a client buy a boat? Should the clients ever have a yacht? We cover that and more. As the kids say these days, let's go. Our email here is askthecompoundshow@gmail.com. Email us if you have a question, want to provide some feedback. On today's show, we tackle questions on how accurate are Wall Street price targets? How do tariffs actually work in practice? When is the best time to change up your portfolio after realizing you took too much risk, especially during a correction? How should financial advisors help their clients spend money? And does it make sense to take a 401k loan and take it for help with the down payment on a house? Today's show is sponsored by our friends at Public. All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, bonds, options, crypto. Bond yields are falling and could fall further if we go into a prolonged economic slowdown. You can lock in 6% or higher yields with a bond account at Public. With a Public bond account, you can invest directly in individual, corporate, and high-yield bonds. Just go to public.com/ATC to learn more. That's public.com/ATC. Paid for by Public Investing. Full disclosures in the podcast description. Read them there. All right. We're recording the show a little early because we will be in Miami for Future Proof Citywide. But I appreciate all of our usuals in the live chat. We will be with you in spirit. Leave us a question in the chat. We pulled one directly from there this week.
Should we go ahead and name people that we can depend on to be in the chat? We got
Dave
Dave
is here.
Yeah. Cliff, maybe
Cliff
Roger
is
Weatherford.
Yeah. Duncan's mom is here.
Maybe. Yeah.
Maybe. All right. Let's do it. Next, let's do the first question.
Okay. Up first today, we've got this one. This one doesn't have a name attached. This one might have come in from social media. With Wall Street coming out with their 2025 price targets, it would be super interesting to get your take on how inaccurate the original price targets end up being. I think you, or maybe it was Sam Rowe, have written about how stock market returns are rarely average. Yet it seems these strategists usually put out estimates that are closer to averages instead of recognizing that we are way more likely to have big swings up or down. Thanks for all of your amazing content.
Okay, Bloomberg did a really good piece on this. And Sam Rowe, friend of the show, did this as well. He always tracks these at the year end. I'll get into his stuff too. So, Daniel, give me a chart on. This is Bloomberg made this. And they show strategist predictions going back to the turn of the century. And they show the range of those predictions, then what actually happened. And here is the kicker. So the 2025 forecast was a 9.1% gain, and they said if this is giving you a sense of deja vu, you're onto something. Over the past 25 years, more than half of all the firms forecasted, so they look at like 375 firms that Bloomberg tracks. They said half of those forecasts for the given year is a gain of 0 to 10%. So they make it pretty boring. They say in 7 of the past 8 years, the market's returns were outside of the range of all forecasts compiled, often collectively underestimating the index's return potential. So what happens here? You can do chart off. What happens here is they say, it's 5 to 10%. And the returns are rarely like that. Let's show up this first one from Sam Rowe at Ticker. That's TKER. He looks at the 2024 price targets, and you can see that they were very underwhelming. The market ended up being much higher. Daniel, go to the next one. This is 2025 price targets as of December 6th. And they, again, predicted it's going to be like a 8 to 10% year. Of course, the problem is the market nosedives immediately this year. So what happens? They don't keep those original forecasts and stick to it. They change it. So Daniel, throw up the next one. This is from David Ingalls at Bloomberg showing that Goldman has already cut their price target for the year from 6,500 to 6,200. This is what happens. It's like it's a target, but it's a moving target. So as the actual returns come in, and if they're higher than average, like they were the years before, they increase their price target. And if they're lower, like things are already going down now, then they lower their price target. This happens. Yardeni Research did the same thing. They cut their price target from 7,000 to 6,400. Now, some people would say, hey, listen, they're changing their mind. This is a good thing. But what just happens is they do these really kind of simple estimates, and then whatever the market does, they get closer and closer to them as the year progresses. Now, here's what I would do if I was a Wall Street researcher and I had to do a year-end forecast. I'm glad I don't. 3 out of every 4 years, I would predict it's going to be a 20% gain in the market. 1 out of every 4 years, I would predict we're going to see a 15% loss. Those are roughly the averages you see in any given year. When the market is up, the average return is roughly 21%. When it's down, the average return is a loss of like 14%. So I would 3 out of every 4 years, I'd say it's going to be a 20% gain, and most of the time I'd be right. And one out of every 4 years, I would say it's going to be a 15% loss, and occasionally I'd be right. And I would be the analyst who predicts this stuff closer than anyone.
Which hurts an analyst's reputation more, to miss big to the upside or to the downside?
I guess if you were the one person who said this is going to be a 13% loss this year, if you were, yeah, no, I think people would, it would stand out that way, yeah, on the downside for sure. So the question is, why do they do these though? And I think it's just because they've always done them, right? And I think investors care more about the thought process that goes into the estimates than the actual estimates themselves. But yeah, I don't think anyone actually looks at these and goes, oh, okay, Wall Street says we're going to be up 10% this year, so we're going to be up 10%. I don't think anyone actually uses them like that.
Which are more accurate, single stock price targets or market calls like this, generally speaking, you think?
Probably market calls, even though they're not very accurate. Because yeah, I don't. The single stock ones are rarely on. Those are harder to do as well.
Yeah, I see those all the time that are just like way off, and they haven't changed, you know, and they're like way off, or then they'll finally cut it a little bit, but they're still way off from where the stock is actually trading.
Yes, if a stock has been up big for years and years, and they're way behind, they finally put it up a little bit, or vice versa if it's going down.
Right.
Yeah, but it's the folly of forecasting. It just proves how hard it is.
Yeah. For fun, we should just start making calls on the show and then just illustrate the point.
Yeah,
Be
compliance
kinda
would love that.
Yeah.
Hi, Patricia. All right, next question.
Okay. Up next, we have a question from Harry. I was trying to wrap my head around these Trump tariffs and truly form an opinion. What's the most likely economic outcome here?
So we've gotten a handful of questions about this. Dave in the live chat asked something similar last week. And it's obviously hard to ignore given how much they're in the headlines and how much they're impacting the market. You can't say that these things aren't impacting the market. Look at what's happening. Daniel, chart on. Since Inauguration Day, and we went and we had a couple new all-time highs, and then since then it's just straight down basically. And this is all tariff related, right? So I don't want to speak exactly to the current policies because they seemingly change by the hour. So I want to do a history lesson on tariffs. So JP Morgan's Michael Semblis did this piece. Danny, you can throw the next chart on. He looked at President William McKinley. He did tariffs that were very popular at the time in 1890. He says they caused an immediate inflation spike. Voters were unhappy. A few months later, the GOP lost 100 seats in the 1890 midterm election. He says that GOP loss in 1890 is the third largest in history of the House going back to the Civil War. So everyone wanted these things. It sounded great. They actually implemented them. Inflation took off. Everyone hated them, and they voted the GOP out, right? If you want to know about trade, this is by far the best book you can get on. It's called A Splendid Exchange, How Trade Shaped the World by William Bernstein, one of the great financial thinkers and writers of all time, one of my personal favorites. A little bit of a dense book, but the whole book is it goes through the history of trade going back hundreds and hundreds of years. And he looked at the Smoot-Hawley tariffs in the 1930s. And so President Hoover and the government passed these tariffs during the Great Depression in 1930, thinking that would help. So Bernstein says by 1933, the entire globe seemed headed for what economists call autarky. I can't even say it.
Sounds right.
A condition in which nations achieve self-sufficiency in products, no matter how inept they are at producing them. The outcome, of course, was not great. Listen, we had the Great Depression, so that didn't help. But economists have studied this, and they say between 1930 and 1933, worldwide trade volume fell off by 1/3 to a half. So everyone did this, right? And then they said they figured it was 3 to 5% of world GDP. Now, people probably didn't realize it that much because GDP globally fell like 20% during the Great Depression, but it certainly made things worse. And they say goods got way more expensive. And so the whole, and Bernstein goes through this whole thing where that isolationism and protectionism that came because of the Great Depression was one of the causes of World War II. And so that's another unintended consequence of this, is it's like we're protecting our own. That can lead to potentially more conflict. Daniel, throw up the chart here. This is from the Splendid Exchange, where he looks at from World War I to World War II what happened with trade, and you can see it totally leveled off because of all these tariffs and all this protectionism that people put on. And then after World War II, shot out of a cannon and things took off again. The entire book is worth a read, but I thought this anecdote was really helped with the benefits of free trade. And he says in 1929, Americans spent 24% of their income on food. Duncan, what is it today?
10%?
Yeah, 10% or so. Obviously, the world is a different place now than it was in 1890 or 1929. That's obvious. But I think like some targeted tariffs on a country like China to help protect certain industries in the United States makes sense, but these blanket tariffs just don't make sense to me. It's like cutting off your hand because you have a hangnail. I don't understand it. Friend of the show and former guest Colin Roche explained the downside of tariffs like this. He says there are primary ways that tariffs impact people. So they raise prices for consumers, they reduce investment and eat labor cost, they increase investment in a timely and costly supply chain adjustment, and if none of the above happen, then shareholders eat the cost via lower prices. The problem is there's no companies that are investing in new plants and equipment and manufacturing right now to help with these tariffs. It just takes too long, right? So what we're going to see is higher costs and higher prices and unfortunately higher inflation. So if you want to know why the stock market is selling off, that's it. The stock market cares about earnings and margins are going to be hit and earnings are going to be hit if this continues to happen. Now, of course, if these tariffs do go into effect and people get used to them, the market will eventually get used to it. Corporations will adjust. We'll move on. But regardless of your political affiliation, this is just bad policy, plain and simple. And the stock market sniffed it out immediately.
That's what's kind of funny is even if this somehow ended up working for the economy, it would take so long that a future president will claim it as a victory for them.
True.
So,
And corporations look at this and they know this. They say, wait a minute, are we really going to spend this much money to bring all of our manufacturing back on shore? And then in 3 years, someone changes the policy completely. Why would we do that? And that's the problem here.
yeah, makes
All
sense.
right, let's do another one.
All right, up next, we got one from Sam. I'm a youngish financial advisor. I've been worried about a client of mine who was taking too much risk during the bull market. They wouldn't sell their growth stocks with large embedded gains and didn't want to own bonds or foreign stocks. I've been trying to scale them back, but they wouldn't listen. Now that we're in a correction, it feels like an opportune time. The individual stocks they're still holding on to are down 30 to 50%. Diversification is working again, for now at least. How do I approach this conversation without making it sound like I'm lecturing them?
Second show in a row where we have received a question from a young advisor looking how to approach client interactions during a correction. So let's bring on another advisor who's experienced, who's worked with clients for years.
Hey, Blair.
Blair
Hi.
duQuesnay from Ritholtz Wealth. Blair, I like this question because there are always those clients who get a little over their skis during a bull market, and they need to be reined in a little bit. So the question is for you as an advisor is how do you have the correct bedside manner to politely not make them feel bad about themselves, but just have a conversation of, okay, everything felt fine for you in your perception of risk during the bull market, but now that you see the other side of this, how do we right-size this portfolio or this plan?
Yeah, these are never easy conversations, but Sam has done the right thing in that he gave the advice in advance. So at least the clients already had the opportunity to hear that he's going to be consistent, right? I think the number one thing you can do as an advisor is to be consistent and give similar advice in all market conditions. The worst thing you can do is change your stripes unless you're an active manager, which most financial advisors are not. So you've got the upper hand here. You hit the nail on the head. No need to lecture. They heard you the first time, so you don't have to remind them I told you so. But just continue in a calm manner to try to explain this is why we advocate for diversification. The things that were working yesterday, those large cap tech growth stocks have been working for what seems like forever at this point. Bonds have been hated by investors since the great financial crisis with low interest rates, and then we get a spike in rates and bonds didn't provide diversification, so everybody hated bonds. Actually, for the first time in a long time, they hated something more than bonds at the end of last year, and that was international stocks, and we've seen that completely reverse course. So there's no need to remind them. They heard you the first time. So just acknowledge what they're feeling. The challenge now is going to be the anchoring to the high price, right? You mentioned 30 to 50% off their highs. That's really hard. So I would try to walk them back and help them understand what their return has been since inception. So hopefully they still have huge gains in these stocks.
Yeah, a lot of those growth stocks are still up if they've held them for a few years, probably.
Yeah. I was looking the other day, Nvidia is still up 400% over the last 5 years or something like that. So remind them that they've still won the game. And just like they didn't have to pick the bottom to get into these stocks, they don't have to pick the top for an exit point. It's also not all or nothing. You can just peel off a portion of those gains and diversify into other places. And so hopefully the market's already done the most of the work for you in showing that diversification actually does work, even if you have to wait a while to see the benefits.
And we've had a ton of clients come to us over the past 5 years. And with that same thing, I've owned Apple for 10 years. I've owned NVIDIA. I've owned Microsoft, Tesla, whatever it is, and I've got huge gains. And that's like their baby. They do not want to let that go, and they know they need to diversify. Like, listen, this thing is 30% of my portfolio now. It's got huge gains. I know that these stocks can and will crash, but what if it keeps going up? And it's such a hard thing to do. And to your point, a lot of the clients end up getting on a plan where it's the opposite of dollar cost averaging. They slowly but surely get out of it, and they that way they spread out the tax hit a little bit. And now the problem is eventually these things will crash or could crash, and then you worry like, oh man, why didn't I get out fast enough? But that's the thing to kind of ease the pain a little bit, is to slowly but surely sell slowly out of it, so you're diversifying your exit points.
Exactly. And it's really hard. People fall in love with these stocks. They've produced incredible returns. Take a victory lap with the client. You've gotten great returns out of this. Let's peel some of these gains off the table and lock in a more consistent rate of return with some of the gains going forward from here. It may take some time, but just keep being consistent.
And we've gotten a couple questions again from younger advisors who maybe haven't been in enough of these battles, and you've been through plenty of corrections at this point with clients, and so you know how it works, right? You've seen enough of these. You know the way clients are going to react. Certain clients are going to get all euphoric and stuff when stocks are going up, and they're going to be despondent when stocks are going down. But other clients that you've worked with for years, you've set the right expectations in place. You've dealt with them enough. You know how they're going to react. And most clients eventually just don't freak out anymore. You don't get this. So there's always going to be a handful, but most of them end up just kind of figuring it out, right?
That's absolutely right. As your length of time with the same client grows, you're going to have been through multiple corrections with the same client, and eventually it will click. And it doesn't mean that somebody who's extremely risk averse is going to become extremely aggressive, but they will become comfortable with the market, especially if you have that same calm, consistent message. And don't forget, acknowledge their emotions. We're all feeling the same emotions to some extent, even advisors who have been through this rodeo many, many times. It's always scary when the market starts to tank. I mean, we just had 10% correction in a very short amount of time. So it's always good to start by acknowledging their feelings and hearing them out, and then just continuing back with that same consistent, calm message that you've always provided. Eventually, it will click.
And hopefully you do figure out the right size portfolio for the person that's durable enough for them to handle any market, right? Like, okay, let's talk about this. Maybe you did take on too much risk, and this 80-20 portfolio that you're in, obviously it's too much for you. You can't handle it because of your circumstances or because of your emotional attachment or whatever it is. Maybe let's talk about a 60-40, and that would make more sense to you. I think that's the idea, that hopefully eventually you get to the point where they can just pick a balanced portfolio that they're happy to stick with no matter what the environment is.
Yes.
What percentage I was just going to say, what percentage of wealth management clients call up and want to put more money to work in market turmoil?
There are a few, and it's mostly the clients who've been through this with me and with that same advisor before. They know how it works. So there are a few who are just wired that way. They actually tend to be more women that want to put money to work when the market's down, interestingly
enough. Those are
enough.
great calls to receive, too. As an advisor, that's when you know that you've done your job and people want to lean into the pain. That's a great feeling.
It is. And one of my most risk-averse clients did that in 2020, and I just wanted to give her a standing ovation because it was amazing.
Yeah. All right.
Cool.
Let's do another question.
All right. Up next, we got a question from Nathan. Why would a financial advisor recommend a client buy a boat? Isn't that irresponsible, Ben?
All right. This was directed at me. So on last week's show, there was a question from a guy who made a killing on Palantir shares, right? And he was wondering what to do with his proceeds. And he said, should I leave it in here? Should I diversify and invest in something else? And I threw out, you made a ton of money, because he turned like $24,000 into like 250 grand. And so I said, you can also do the opportunity cost of how will you feel in 10 years if Palantir goes nowhere, and you could have taken this proceeds and bought a boat or bought a house or whatever it is, take a nice vacation. And everyone in the chat said I was nuts. How could you possibly recommend buying a boat? What is it? It's bust out another 1,000 or whatever. It's a financially responsible decision, which I thought was funny because the classic book, I'm coming to lots of books today, Where Are the Customer's Yachts by Fred Schwed.
Wow,
that
look
was the
at
whole
all those
thing.
Bookmarks. Wow.
Yeah, that's right. Yeah, I read. Not to brag. Saying it was just Wall Street getting rich and not the clients. So Blair, we're both boat people, so maybe we're a little biased, but I just want to hear from your side of the aisle as an advisor. How do you approach getting clients to actually spend and enjoy some of their money? Because we know that everyone in the spreadsheet mind wants to continue to grow it and hoard, but how do you get people to listen? Part of the job is actually, no, you want to enjoy this money. What was the point of it in the first place? So how do you
Yeah.
do that?
Yeah, so I'm not going to go all Susie Orman on you and try to determine whether it's irresponsible or not to buy a boat. For a lot of people, it's not irresponsible. They've saved, they've invested, they've been disciplined over time. Now they have a pot of money. What's the point of that money just watching it on a statement? So it's best to tap into the client's personal goals. If buying a boat would make them happy and they can afford it and it makes sense for them, they should 100% buy that boat instead of just continuing to look at numbers on a piece of paper or on the screen. I do, I get this question from clients. What we know about boats is that it's not just the price to buy a boat, it's the price to maintain a boat. I do also recommend it's always better to have a friend with a boat than to own one yourself. It's
true.
a lot of work. Anytime the boat cranks, we clap, right? So boats are finicky. Just know that while they actually hold their value better than cars, they don't depreciate as fast. Those maintenance costs and the gasoline and all the things you're going to have to do to upkeep that boat are really the cost. So just consider that in a financial plan. But I'm really glad that this question came up because I just wrote recently about, sort of accomplishing my long-term financial goals that I've had for many, many years. I finally took my kids on the first ski trip. I've gotten to the point where, I've accomplished that goal. And so I actually now I'm going to make this a goal of mine. I love boats. I don't own one myself. And so I pulled a picture of a boat that's for sale. This is the boat that I would buy. And this is going to be my new goal. I don't
So
really
that's
like the
that's
colors.
a wake boat, right? Am I right on that?
This is a ski nautique. Now, I'm not a wake person. I'm a classical slalom skier, and all these boats are made to like sink and make these heavy wakes for the wakeboards and the wake surfing and all of that. I'm not really into that. But I'm not going to go back and buy a really, really old nautique. So this was one with a sleek hull that I found in 2018. $99,000 is the cost of this boat. Do you know that the 2025 Nautiques are over $400,000 now? This is just insane.
Okay, boats
How
are.
expensive ski boats are now.
So I want to give you my experience with boats. So like you, I grew up on the water, and I always had a friend who had a boat. My family never had one, but I always had tons of friends who had boats and jet skis, and so I was just always in the passenger seat. And we got our place on the water a few years ago, and my wife and I both said, no, boats are not for us. We're not boat people. I know nothing about them, taking care of them, or anything. But the more we were on the water, the more we realized, guess what? This is an experiential purchase. Yes, it's expensive, but you're out on the water all the time, and so we got a pontoon. And I figured that was the easiest one that I just I couldn't possibly break it or do any damage, right? If I hit the dock a couple times as I'm docking, so what? Also, sidebar, this is how not a boat person I am. I still call it parking sometimes, and I always get people telling me, no, it's not parking, it's docking. You got to say it right. Okay, so that's the person I am. But we got it, and we absolutely love it. Every single weekend, we're out there with our kids, and we are out in the sun. We're not in front of screens. We're on the water. We're taking the kids tubing. We're going to places on the lake, playing at the sandbar, and it's honestly been way better of an experience that I ever could have imagined. I love it now, and I never would have thought that in a million years before. Now it is, yes, there's storage, and gas is very expensive. If you're a teenager, becoming filling up the gas, that's a great job because you get good tips. And but yes, I think it's an experiential purchase. And if, like you said, if you go in with your eyes wide open and know how much the ancillary costs are going to be, it's a really, really fun time.
I will say, if you weren't a boat person, do your homework, learn about boating. I do see a lot of people out on lakes where I go in the summer. You can tell they didn't grow up boating. So take your lessons, do the homework, learn what you've got, learn how to maintain it, learn how to drive. But if boats are for
Probably
you,
don't buy a sailboat before you know how to sail.
True. I'm also a sailor, and that is a lot of hard work as well, even if you don't have the motors. So big fan of boating, but just tap into what your personal financial goals are. If the boat is what's going to do it for you, go for the boat. If it's the car, if it's the vacations, figure out what brings you joy, spend money on that, and then save money in other places.
Yes. I always say that my favorite updates from clients are, hey, we took this trip here. It's amazing. Here's a picture. Hey, we bought this convertible, or we bought this vacation home, or we bought a boat. Though that's when they realize they can do that and still achieve their financial goals. That's the best.
That's what we're here for. That's the joy in being a financial advisor.
Yes.
And
All right.
and if you can't buy a boat right now, there's always paddle boards. You know.
And kayaks.
Blair, to your yeah, stand-up paddleboards, I like those. Blair, to your point though about boats lasting a long time, this is something I didn't know. I had to research this because how long does a boat last for? And a lot of people said 15, 20, because if you take a loan out for a boat, most of them are like a 15-year loan,
Yeah.
right? Which I did not realize. It's almost like taking out a mortgage.
Yeah, and they after a certain point, the boat value actually holds quite well. And it's all about the hours. Now that you're a boater, you probably know about this, not the miles. And people rebuild classic boats as well. So I see boats from the 1930s out all the time. Again, you're basically buying a new boat at that point, but they are great vessels. But they have a lot of maintenance and they're very finicky. So
You also have to have insurance, right? I'm
of
guessing.
course,
Yes, insurance, which is not too expensive. But yes, if my boat broke down, I'm not going to be able to fix it. I'm calling someone.
You need a good mechanic. Yes.
I'm stuck. Yes. All
You
right.
gotta have a boat guy.
One more question.
Okay, last but not least, we got one from Amy. I know it's frowned upon by some experts, but I'm thinking about taking a 401k loan for a down payment on a house. Rates are ridiculously high, and saving up for a down payment is going to take my husband and I forever. I know the pitfalls if I lose my job or something, but I have a stable position. Will you give me the green light to take on a loan so we can finally afford to buy a house? I can relate to this one, and I just had a follow-up question already for you guys on this question. Is this the sign of a healthy economy that people have to write questions like this? It doesn't seem like it to me, but I'm not a finance person. But
Well, not a healthy housing market, that's for sure, which we've been
Okay.
talking about for a while. And Blair, you've been chronicling your story at the bell curve for a few years now, where fill us in, but I think you were in between houses. You bought a new house, still trying to sell the old one, and so you took a 401k loan to help with the down payment for the new house. So tell us how that all worked.
I did, yes. So we actually talked about this. It's been 2 years. We found the family home and we're going to sell the starter home and decided just to go ahead and own the two houses at the same time. It was too much work to try to get our house fixed up while our little kids were living in it. So I used a 401k loan. Now, a lot of people have come back to me and said, you didn't tell us that the maximum you can take is $50,000. Okay. To some people, that's a lot of money. Other people were thinking, oh, I'll just buy a whole house with a 401k loan. It's limited to $50,000. And there's a lot of downsides to taking a 401k loan. But I did it. I have zero
Wait, hang on.
regrets.
I got a question.
Yeah.
Is that 50k per household or per, like if you and your spouse both have a 401k, could you each do 50? Or is it just...
It's within a plan. So I might have to lean on our tax team
okay.
to.
So if you have multiple 401k, okay.
Yeah, so I might have to lean on our tax team to double check what
and
the
is
rules
it
are.
linked to the total amount that you have? If you only have 50k
It is.
in
It
your
has to
retirement,
be.
can you?
Yeah, it has to be only no more than a certain percentage of your retirement. I believe it's
okay.
50%. So if you only have $20,000, obviously in your 401k, you
Right.
can't borrow 50, and you can't even borrow the whole thing. So
Okay.
yes,
I didn't realize the ceilings on this stuff. That's interesting.
there are limits. You do pay yourself back in interest, and that interest goes in pre-tax. So there's this big, spreadsheet warrior fight about you're going to pay taxes twice on the money that you pay back in interest. Fast forward, it took me 2 years to sell my house, and I could actually pay off that 401k loan that I took over 5 years, but I'd rather keep the cash. We've got a sell-off in the market happening right now. There's just other things I'd rather do. So I'm actually going to pay that loan back over the 5-year period. I decided not to actually pay it off early. I was lucky the cash flow all worked out for me. But I'm actually in favor of this as long as you have the cash flow to make the payments. It's not going to put you in dire straits. You understand, as this questioner alluded to, that if you do lose your job, you're going to have to pay it back or pay taxes as if you took money out of the 401k. So there are definitely pitfalls. It's not for everybody, but it can work. It can be a great way. Like you said, house prices are so high. Down payments, typical down payment, 20% these days. That's a lot of money for people to save. It's a lot easier to save within your 401k. So why not leverage those savings, especially if you're able to pay it back, to get yourself into the appropriate housing situation for you and your family?
What is the interest rate that you're paying on it? How much does it fluctuate?
Yeah, so it is based on market interest rates. When I took mine, and it was a little higher at the time than mortgage rates, when I took mine, the interest rate and the plan was 7%. So I just figured I'm taking $50,000 out of my 401k. I'm turning it into a 7% bond that I'm paying myself back.
Right. Because, yeah, to your point, that money you're paying back, that 7%, it will increase your balance eventually.
And now
It's
I
like
will
an additional
double pay.
contribution.
Exactly. And you can still put your full contribution in there as well, which is cool because you end up putting more money back into your 401k. Not the most tax efficient option. It's not the optimized spreadsheet option, but life is messy. Life is real. Life is organic. So I say if this is a strategy for you, consult with a financial planner, run the numbers, make sure you're not going to get yourself into trouble, but it can absolutely be a source of down payment
Duncan,
for a house.
I see the wheels turning.
Does it make a difference if it's a Roth or a traditional 401k?
So that's a really good question. I believe that you have to take the money out of the deferred bucket, but I could be wrong. So maybe we need to follow up on that one on another episode.
Okay. And you can always pull out of an IRA as well, some kind of loan, or is that not an option?
You cannot take loans from an IRA.
Okay.
If you have a Roth IRA, this is interesting. You can access your contributions that you put in, not the growth, without penalty.
Okay.
Yeah, that is a big
to
benefit
know.
for Roth.
But it's not a loan.
Yeah. So you're happy with the way everything, even though this took longer than you thought to sell your house and have the bridge, this gave, because I'm sure at the time you thought, well, this will take 3 to 6 months or something.
Yep.
But it took you 2 years. So in the end, having the 401k loan really kind of saved you or made it easier for you, right?
At the end of the day, this was the time that we were able to buy the family home. Everybody has a full bedroom now. We have a backyard, right? It just worked out with the timing. The market dynamics changed. I thought worst case scenario, it would take a year to sell our house. It took 2. Luckily, things went well. My income increased. So I definitely took a risk. But it was a calculated risk, just like we take risk with buying triple levered NVIDIA options, guys. Come on. So I took a risk. I knew what the risks were. It worked out for me. There are downsides. But isn't that what we're doing here in a capitalist economy? We're taking risks, right?
Yeah. And that's a calculated risk, like you said. That makes sense to me. Okay. Duncan, you're thinking about it?
Yeah, I've got a lot to think about now. Yeah. I mean, I still can't get over how much house prices have gone up in recent years. So that's the mental block I have to get
Renting
over.
is also always an option, Duncan, as well.
Yep.
I don't
Just
want
think
to
about how
say
much
that
higher they're going to
everybody
be in
has to buy a
5 years
house.
from now, Duncan.
Yeah, I mean, I just, I've lived in places for an average of 2 years for the last, 20 years. So, moved about 10 times. Not my favorite thing. One day we'll buy.
All right. We're going to get a question from Duncan on one of these. Help me buy a house.
Yeah, there you go.
All right. Thank you to Blair for helping out, as always.
Thanks for having
Appreciate it. We got to hear checking on her boat goal in the years ahead. askthecompoundshow@gmail.com is our email. Thanks to everyone watching the live chat on YouTube, watching live on Twitter. Leave us a comment or a question. We'll get to it on an upcoming show. We'll see you next time.
And if you're watching in Miami right now, hope you had fun at Future Proof.
I had an awesome time.
Yeah. See you.
I can tell.
See you next time.